Okay, so hi everybody. So the purpose of this video is to just go through the part exchange of non-current assets. So the intention of this is that you've actually already had a go at this. This is really similar to what we were doing last week, based on disposal of non-current assets. So we get rid of a non-current asset. But the only difference here is rather than selling our non-current asset for money, instead we get a different type of asset. Okay, so the example that you should have worked through is XYZ Traders. I'll apologise, it didn't print properly in your booklet. So if you haven't done so already, you need to pause the video, okay, and you'll find this information here that I've got here. Okay, I'm going to delete that because it looks messy. But you'll find that at the top, on the class notebook for the work that's been set today. So if you haven't done so, okay, come off this video, go and have a go. Okay, you can always do it on scrap paper, and then this video, come back to it, and obviously I'll talk you through what should have been done. Okay, so I'm assuming now that you've done that, you've had a go, okay, and you're using this resource to check and, if needed, to correct your work. Okay. So, the example we're looking at are XYZ Traders, and they've bought some office equipment on the 1st of 1st 2017, and the cost value, okay, was £12,000. So I'm just going to annotate that in, cost, okay, and then also I find it helpful to annotate that this is year one. So it's been depreciated by 25% using the straight line method, okay, so we're going to do the cost times by the percentage method, and it has a policy in which it's going to depreciate in the year of acquisition, that means the year it's bought, and none in the year of disposal. Okay, so on the 1st of November 2019, okay, they part exchanged the non-current asset. Now I can now do my date line, so I was talking to you about this last week. Okay, so we can see year one when they bought it was the 1st of the 1st 17. Okay, so the year end is the 31st of the 12th 17. So all I'm then going to do is keep going through until I get to the date of disposal. Okay, so 31st of the 12th 18 is the end of year 2. Okay, year 3, 1st of the 1st 19. And we can see that they actually part exchange to get rid of the asset on the 16th of November 2019. Okay, so we can see that the year of disposal is in year 3, and I'm going to just check the policy. So it's straight line, and they charge a full year of depreciation in the year of purchase and none in the year of acquisition. So in the year of disposal even. Okay, so we can see that when we do this, we'll have 2 years of depreciation to bring down, but for the non-current asset they're getting rid of, there's no depreciation that will happen. Okay, so on the 16th of November 2019, XYZ part exchanged the office equipment for £2,300. On the same day, they buy new office equipment worth £8,000. So we will have to depreciate for some this year for the asset that's just been bought, and we'll provide a full year's worth of depreciation. Okay, so what's really important here is the reason this differs to disposal is because instead of receiving cash for the non-current asset, they receive new office equipment instead. Okay, but we'll see that as we go through the step by step. Okay, so step 1 is actually record your opening balances, but before we can do that we must label our accounts. Okay, remember I always add on here it's only the cost figure that goes in here. Okay, provision for depreciation, well, a provision is something that reduces an asset. Okay, so it's a liability. Okay, and disposal, remember we've got no label, it's a temporary account. Okay, so we use duality to guide our entries. Okay, so record your opening balances. Okay, so in the office, so I'm just going to do a highlighter on this. Okay, so, oh no, wrong one. Let's try again. Add pen, highlighter, there we go, that's what I was looking for. Okay, so I'm going to do all of my step 1 in yellow. Okay, so record your opening balances. So for the office equipment, it's really easy. We can see that it was brought down at 12,000. Okay, for depreciation, though, we're going to have to work this out. Okay, so I know we're using the straight line method. Okay, I know my cost is £12,000. Okay, my rate is 25%. Okay, so that will give me £3,000 per year. And then if we look back up, we can see that actually we've already identified that we've got 2 years worth of depreciation to bring down. Okay, so we're going to times by 2 years, which equals £6,000. Okay, so that is step 1 done. Okay, step 2 is get rid of the non-current asset out of the non-current asset account. Okay, now what's really important to remember here is that we are dealing with the cost figure. Okay, so if I want to get rid of that whole office equipment, I've got to credit £12,000. If I credit any other number, then it's going to look like we still own some of that office equipment. Okay, now for every credit we have a debit, so in my disposal account, okay, I am going to debit £12,000. So far this is really repetitive of what we were doing last week. Okay, as is step 3, now that we don't own the non-current asset anymore, we can get rid of the depreciation to date. We're not responsible for it anymore. So I'm going to debit in my depreciation account £6,000 because I want to get rid of the depreciation for that non-current asset. We don't own it anymore, so we don't have to charge it. Okay, so it's a debit in the depreciation account, so under duality it will be a credit in the disposal. Okay. Now this is where it starts to change a little bit in step 4. In step 4, what we are doing, what colour I haven't used yet? Not use that one. Okay, so in step 4, what we're doing is recording the proceeds in the disposal accounts. Now where it's different is that this time, rather than get cash, we receive non-current assets. Okay, so if I go back to the information provided, okay, when they get rid of the non-current asset, they gain £2,300 worth of non-current assets. Okay, so I am going to show here that we have gained £2,300 worth of non-current assets. Okay, I know in total it's worth £8,000, but I'll go back and deal with the remaining balance a little bit later on. Okay, but in terms of the disposal, whoops. Okay, we have gained £2,300 worth of non-current assets, so I am going to credit it in my disposal account. Oh, I'm having a nightmare here. Okay, there we go, because I've debited it in non-current assets. Okay. Now step 5 is then again repetitive of what we did last week. To finish off our disposal account, we want to calculate if we've made a profit or loss. So to do that, I'm going to compare the net book value, so what it's worth. Okay, so I'm going to do my cost, which was 12,000. Okay, we think it's fallen in value by 6,000, meaning when we got rid of it, okay, we think it is worth £6,000. What did we get for it though? We didn't get £6,000, we actually got much less. We got £2,300 worth of office equipment. So here we can see that they've got less than it was worth. So they've made a loss of the difference between these two figures. They've made a loss of £3,700. Okay, now to do this properly, what I'm going to do, okay, is I'm going to draw out a quick income statement T account. Okay. I'm going to write out pearls and I'm going to pause for a second. Okay, losses obviously have negative impacts on profits and therefore it would be an expense on the income statement. Okay, now under duality, for every debit we have an equal credit. Okay, so I am going to credit 3,700, okay, into my disposal accounts, and then I can just check what should happen, okay, because this is a temporary account, it should shut, and it does. Okay, we can see here that we don't need to insert a balance, it closes, which gives me reassurance, okay, that I've done something right here. Okay, now what I'm going to do in step 6 is now turn our attention to the non-current assets that we actually have got to replace the ones we got rid of. Now, if we go back to the top, we can see that the new non-current assets were worth £8,000. However, okay, we don't have to record £8,000 from the bank because we've already received £2,300 discount towards these. Okay. So all I'm going to do here is pay off the remaining balance. I don't have to pay the full 8,000. Okay, because we got £2,300 discounted. Okay, so in my bank account, I will have lost 5,700. Okay, but I have gained £5,700. Okay, of office equipment, and what we can then see is that these two together do boost our balance by £8,000. Okay, so that is how we account for the remaining balance. Really simple. Okay, it's just that we pay off the amount that is left to pay. We don't have to pay the full amount. Okay, now step 7. Okay, I'm just going to go back and balance the office equipment accounts. Okay, really simple, we've done that. We've done our Bal C and Bal BD. Okay, and we can see then that our cost is £8,000 at the year end. Brilliant. Okay, and then lastly, I'm going to finish off my depreciation accounts. Okay, now if I think back to the policy, it says that in the year of acquisition, the year they buy it, they do charge a full year of depreciation. Okay, so that makes it really easy. All I have to do is do my 8,000 times by my 25%, okay, which means this year's depreciation is £2,000. If the policy was different, if it was time apportioned, okay, then all I'd do is then find out how many months we'd owned it for, divide it by 12 and times it by how many months, okay, but we don't have to do that in this question because they charge a full year, even though you could argue that's not very fair. They buy it, don't they, right at the end of November. Okay, so all I'm going to do now, okay, is record my depreciation in my depreciation account. Let's use that one, that's a nice colour. Okay, so I'm going to go back up to my depreciation account. Okay, depreciation for the year is increasing by by £2,000. Okay, and then I can balance the account and we can see it balances at 2,000. Okay, now the final things to do are just do your extracts underneath. Okay, so really simple. If we look at the income statements, okay, oops, I've not copied and pasted onto here. I can just do this really quickly. Okay, so on my income statements, if I look back in my ledgers, I've actually got 2 references. Okay, I've got one in the depreciation accounts. Okay, so let's depth the year. Okay, so if I just show you, if I look back in my T account, I've said that the depth for the year on the income statement is £2,000. Okay, and in my disposal account, I've also recognised there's a loss on the disposal. So basically, anywhere where I've written income statement, I'm then going to record that on my income statement. Really simple. Okay, so income statement, 3,700. We can see we planned it was going to be the expense because they've sold it for less than it's worth. Or part exchanged it, I should say. Okay, and then on the statement of financial position, okay, in the non-current assets section, we've got our new cost figure of the office equipment. Okay, so if you look in that account, you've got your closing balance of 8,000, so balance to balance sheet. Oh, sorry, don't know what happened then. Okay, we've got our debt to date. So again, balance to balance sheet, if you look at your depreciation, your closing balance is £2,000. So to work out what we think it's currently worth, cost minus debt to date, so what it was worth, how much it's fallen in value by, gives us £6,000. Okay, now if you've got any questions, please make sure you are asking me. Okay, remember about the cover technique. So if you did get a few things wrong, then get a blank piece of paper. Okay, cover up the T accounts and have another go. Okay, and then once you're feeling happy, go back onto the class notebook because you've got a few other tasks to do. Thanks.